Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Great to have you with us here at AusBiz. Well, let's see what happened overnight. Globally, fairly negative session. European stocks, they ended lower ahead of key inflation data out later this week. Wall Street was mixed. The Nasdaq breaching 17,000 for the first time, while the S&P 500 was flat and the Dow fell as Treasury yields rose. Nvidia, again the focus for investors following the long weekend, with its shares building on recent gains following last week's results. It boosted shares of other chip stocks. Apple shares initially rose after iPhone sales in China surged more than 50% in April from a year earlier, with sales expected to be boosted further this month as Apple launched an aggressive discounting campaign. GameStop shares surged after the video game retailer said on Friday that it had raised $933 million by selling 45 million shares as part of a at-the-market offering. And Hess shareholders approved its $53 billion merger with Chevron, boosting the stock price of both the oil and gas companies. And the retailers, they're in focus this week, with several, including Dollar General, Advance Auto Parts and Best Buy, due to report results. And US trading has moved to a shorter settlement time, with investors now having to settle their transactions one business day after the trade instead of two, which regulators hope will reduce risk and improve efficiency. Well, US consumer confidence unexpectedly improved this month after falling from previous 3 consecutive months as labour market optimism grows, while consumers' 12-month inflation expectations have risen to 5.4%. And US house price growth slowed sharply in March, rising just 0.1% as those rising mortgage rates weighed on demand. Meanwhile, Fed member Neel Kashkari saying, "I don't think anybody has totally taken rate increases off the table. I think the odds of us raising rates are quite low, but I don't want to take anything off the table." Well, US Treasury yields have climbed to multi-week highs as two lacklustre debt auctions raised doubts about demand for US government debt, with the auction of $69 billion in new US 2-year notes and $70 billion in 5-year treasuries. The 10-year rising to 4.53%. And the US dollar has gained while the Aussie is sitting at 66.5 US. And in fact, the local currency is going to be in focus this morning when the monthly consumer price index is released, which is expected to be a slight drop in April. Well, let's get across what is moving on Wall Street. To do that, we're joined by Kenny Polcari from Slate Stone. Kenny, terrific to catch up with you again. It's been a long time since we've had a chat. So I note you're looking at what everyone else is looking at in the Fed, and you're saying, really, you should stop focusing on that. Why is that?
Well, because ultimately, what are we really talking about? Is the Fed going to lower rates by 1/4 of a basis point? Is that really going to change the narrative or change the landscape? It really isn't. We're not talking about, we're going off the edge and the Fed is going to cut rates by 1 full percentage point. And we've been talking about this for a while. So it's almost people that are trying to build a portfolio or trade around what the Fed is going to do. I think they're making a mistake. Now, Neel Kashkari, to your point, did make a comment, and he's made this comment over and over. This is not new, that he has not taken rate hikes off the table. And while Neel is not a voting member, so really anything he says doesn't, he's not a voting member, he doesn't get to vote, but it could be the way of the committee's way to leak the message, to get the message out there that in fact rate hikes are still very much on the table. As small as the chance may be that they hike them, the fact is they're not taking them off the table. They want to leave that door open just in case we see inflation continue to kind of trend upward as we've seen over the last 3 months.
So, Kenny, what are you making of the US economy at the moment? I was just highlighting there, consumer confidence fairly high. Yep. That strength remains there.
It's kind of interesting that the consumer confidence number did come out better than expected, because it feels to me like people are stretched. You're starting to see where people are getting stretched. You saw it in what McDonald's had to say, what Walmart had to say, what Target had to say, that you got even people that, middle class or upper middle class earners that are now coming down to Target and Walmart shopping, because you can sense that there's this sense of not despair, but exhaustion, right? People are tired of these ongoing high prices and ongoing inflation, and it's starting to kind of hit them. So, which is why I was surprised that that number came out as strong as it was, because if you're living here, it doesn't feel that way for sure.
So, the back end of earnings season, what's your takeout? Because certainly forward guidance has been relatively strong. We've had a lot of beats there. What's that telling you?
Right. So to your point, that's exactly right. The guidance, the earnings, I think we're better than 80% on beats, right? On revenue beats and earnings per share beat. And the guidance has been strong. And so therefore, it's hard to argue that, right? It's hard to argue that 5.25% rates, which everyone's screaming out, oh my God, they're so high, they're so high. It has done nothing to slow the economy. Ever since we got here at 5.25, which was 1 year ago, May of 2023, we went to 5.25, 5.5, and the S&P is up just over 30%. And so therefore, it's hard to argue that we're in restrictive territory or that these rates are cooling demand. They're not yet, which is why I think that higher for longer narrative, meaning we're going to hold them right here longer. We're not going to raise them, but we're not going to be in an effort to cut them. Now, that being said, we continue to get the robust guidance. We continue to get better than expected earnings. And so all that tells me is that the economy continues to hum along. And so therefore, if the Fed is data dependent, there's no reason for them to do anything at the moment because the data continues to suggest strength.
And if they were to cut, it's because the economy would be weakening, which obviously then would impact earnings.
Well, and that's true. And so you have to be careful what you wish for, because if the economy suddenly does turn weak and then the Fed starts to cut, right? Once they start to cut because they said it's turning weak, then they've already missed that ball, and then the economy is going to continue to get weak, and then it's going to be chasing it down the same way we chased it up. So I understand that they want to try to preempt it, but I'm just not sure now's the time. And to your point, yes, if they start cutting, it's one of two things. It's going to do two things. It's going to potentially stimulate demand if we still have a strong economy. But then if they start cutting into a weaker economy, then it's going to certainly kill demand, because people are going to recognize that, the economy is now spinning out of control and down the drain. And so they're going to naturally pull back. And so either way, I think the Fed is in a tough spot. Because partly I think they were late to the game in raising rates, and now they're in this funny spot where inflation is starting to tick up again, something we worried very much about. And then they can't cut. Certainly they can raise. They don't want to, but they can, which is why I think they're keeping that narrative open just in case. And so I think it's in a tough spot, but I do think the economy is okay, and so I'm long-term bullish on the market. I think we hit some pockets over the next couple of months going into the summer, going into the election, which is sure to create all kinds of chaos and drama. But remember, you don't build a portfolio or trade based around political events.
And certainly that market breadth has increased, which is clearly a positive. Yet it's still pretty hard to avoid the Mag 7. I think there's reference now as the Mag 1. It's all about NVIDIA, isn't it?
Right, yeah, it's all about NVIDIA. And really, you saw the earnings from last week. You saw what he said. I mean, it really is incredible. And now they're on this, he called it the rhythm method. He's on this 12-month process. Every 12 months, they're going to introduce new technology and new technology and new technology. And so we're very much in the infant stages of this AI boom, this revolution that's happening. And so I think you have to own it. I think it's got to be part of your portfolio. Look, they're splitting the stock 10 for 1 in a week and a half. So it's going to become, $110 stock, which I think is then going to create even more excitement, because people, they think, well, if I need $1,100 to buy one share. Well, now I can buy one share for $110 or two shares or three shares, whatever it is. They feel like they can get in at the retail level. And I think it's going to create even more excitement for not only the stock, but certainly for the sector.
So, Kenny, fair to say the bull's still very much in control. You only have to take a look at the VIX. It is at those low levels.
Yeah, the VIX is at historically low levels, which suggests complacency, no fear, which is itself a contraindicator, because when it gets that level and everyone's like, oh, what could possibly go wrong? That's exactly when you have to be worried, because all you need is one event that nobody expects when the VIX is trading this low to really set it in motion and send the VIX soaring, and then stocks will come under pressure. So I think you have to just understand that and then build your portfolio around, a little bit defensively, and be prepared for a pullback, because I think the pullback is coming. I'd love to see the market shake out a little bit. I'd love to see it back off, 5 or 6%, which is still well within the normal trading range. But it would get some of the fluff out, right? It would get it would shake the branches a little bit to see who was really in and who was not. And I think it's actually healthy because if you look at the chart, it's just gone straight up, right? It hasn't pulled back very much at all. And so I would love, just from I'm being a little selfish. I'd love to see it pull back because I want to buy stocks cheaper.
So you're taking profits, increasing your cash levels?
So I'm not taking profits, and the names that I own, I like, I'm going to hold. But I'm putting new cash that I'm putting to work is sitting in cash, right? It's going to earn 5.25% in my Fidelity money market fund. So it's not as if it's not working for me. It is, but I'm just not chasing it. I'm certainly not chasing tech up at the top of the range. Look, the Nasdaq just went through 17,000, making a new high. Right. And so names like NVIDIA, which are great, I own it, so I'm participating. So it's not like I missed the boat, but I'm not chasing it up here. Right. New money that I'm putting to work, I got sitting in cash. And when I think the market's going to back off, because I think it will, then there are other names, other sectors, right, that I need to add to balance out the portfolio. So it might be consumer staples. It might even be utilities. Look what utilities have done this year. They're up nearly 15%, and they are the most boring sector that you could possibly invest in, and they're up 15% this year. Because there's a lot going on in the utility space when you think about energy demand and where it's coming from, whether it's coming from EVs, whether it's coming from crypto mining, whether it's coming from, NVIDIA chips. It's dramatic, and it's dramatic around the world. It's not just here in the United States. Energy demand is expected to grow. So I think utilities, the performance of utilities this year so far has expressed that. So I think there's lots of opportunity, but it doesn't mean you have to go chasing things. I mean, you can afford to be patient and wait for the pullback a little bit.
Kenny, terrific to get your outlook. Thanks for joining us from Slate Stone.
Always a pleasure, Andrew.
All right, a quick check of where we're likely to get going on the open there. And as you can see, fairly negative start. Futures there off 0.6%. Stay with us. The open is just a couple of minutes away.